Good morning, good evening, everyone. Welcome to this logistics webinar around the ocean markets. My name is Schulze. I'm the global head of ocean freight here at Flexport, and I'm super excited to spend the next 1 hour with all of you. We have a lot to cover. We'll stick our neck out a little bit and predict the ocean markets rest of this year and going forward. For the very same reason, a big fat disclaimer right here, because it is indeed very hard to predict the current ocean markets. It's probably as hard as predicting the stock markets, if not harder. Nevertheless, we'll give it a try, but no guarantees on what we're presenting right here today. To make these predictions, we need the very best people we can think of. So I'm super stoked to present the two panelists today. First off, Lars Jensen, CEO of Vespucci Maritime. Lars comes with 25 years of ocean freight experience. He started his career at Maersk. Then he founded his own company, where he's essentially acted as an advisor to shippers, carriers, freight forwarders, and essentially every party in the supply chain over the past good 10 years. Welcome to you, Lars.
Thanks, Anders.
Next to Lars, I have Florian Braun. Florian joined Flexport at the beginning of this year after a long career at Schenker Freight Forwarding. Before Flexport, Florian had founded his own company, Digital Ventures. So super excited sorry, Digital Navigators. Didn't get that quite right, Florian. Sorry about that. But nevertheless, welcome to you, Florian. Super excited to talk to you today.
Thank you, Anders. Excited for the webinar.
Cool. Let's take a look at the topics we have ahead of us today. Quite meaty topics right here. First off, we'll dig into what we're seeing at the moment in terms of current transit times relative to what we have seen historically, not only from the ocean leg, port to port, but all the way from factory to final destination. Then we'll take a look at the supply and demand trends we're seeing out there. What demand are we expecting in the time to come throughout the trade lanes against the expected supply in terms of both vessel space and equipment from container boxes. Finally, we'll dig into the rate or the price trends we're seeing out there. We all know and are acutely aware that it's all-time high, but what to expect come rest of this year. And then we'll talk a little bit about solutions, better manage expectations up front. It's all about being resilient and agile in this environment. There is no silver bullet, but we have a lot of tips and tricks for how to navigate this the best possible way. Since we have two very chatty gentlemen joining us today, Lars and Florian, we have not set aside time for verbal Q&A, but in return, we have 5 freight experts from Flexport joining us in the app right here. So if you have any questions, please just submit them in the app, and the handful of freight experts will instantly respond. If you have any questions for Lars, we'll also make sure that we follow up with all of you separately, because it's going to be hard for Lars to both type and speak at the same time. Nevertheless, let's get going. So Lars, the last time we spoke was 4 months ago. At the time, we talked about this vicious ocean cycle that we're seeing right here. At the time, it had been sort of spinning for 8 straight months, and we're now coming up on a full year where we're seeing this cycle continuing. Ever since we spoke, 4 months ago, Lars, has this improved or deteriorated? What do you see out there?
No. No, I expect you to expect a slightly longer answer than just plain no, but no, it has not really improved. And I know we're going to talk about some of these elements. So not only have we not seen these elements improve, but let me add another one that doesn't quite fit on the wheel. We normally always have disruptions. You normally have, say, vessels with an engine breakdown or smaller ports here and there with a port strike. That is completely normal. And usually that doesn't lead to large additional effects. But because of what you're showing here, we now have a disproportionately large effect. Right now, every time a vessel suffers, for example, an engine malfunction, there is no backup. There is no opportunity to just put in another vessel because there is zero slack in the system. So not only do we continue to see this vicious cycle, we're also seeing that normal operational mishaps right now cannot be handled the way we usually see. And therefore, we have a much larger negative impact from those.
Thanks for sharing, Lars. So tough news to start with. You're saying it's gone worse. We're seeing yet another impact hitting this vicious cycle right here. Let's take a look at the port congestions, a big topic. We're all seeing, the stats left, right, and center around what the port congestions look like. In here, we have outlined the trend for the Port of LA and the Port of Oakland. The good news when you take a look at the trend for the Port of LA is that the number of vessels at anchorage, essentially waiting to berth, has dropped from just shy of 40 to just shy of 20. However, other ports like Oakland, in this case, have actually increased in terms of vessels waiting at anchorage. Oakland has jumped from 10 to 25. So, Lars, help us understand what's happening here. Is this essentially a zero-sum game, or how do you see sort of the port congestion issues at the moment?
Unfortunately, it is kind of a zero-sum game. The only way, of course, you can remove a queue is if you can operate more than what you normally get in your flow. And because of the demand boom we are seeing right now, the port infrastructure would, under normal circumstances, be hard-pressed to even handle the actual flow we have. So on top of that flow, you have to whittle away at the queue. That just takes an enormous amount of time. And let us not forget, most of this industry is extremely agile. If you have a large spike in demand in one place, we can move ships, we can move containers. The one thing we cannot move in terms of capacity is ports and terminals. Here we're seeing a good example. If I want cargo to move in to, in this case, California, if I want it in through Los Angeles, Long Beach, sure, I can try to move it up to Oakland, but that doesn't really change the overall capacity available. So to some degree, it is a zero-sum game, and we cannot rapidly ramp up capacity in the choke points of the ports.
How do you foresee, for example, the Port of LA, Lars? Will this trend continue going down, or could it spike up again?
For the short term, I would tend to say here rest of 2021, I actually expect this to slowly continue to trend down as we're whittling away. The one thing that I have my eye on when it comes especially to these ports is actually 1st of July 2022. Because let us not forget that under the normal labor contracts, the labor contract between the terminals and the Port Workers Union, ILWU, expires by the end of June. And normally these are multi-year contract deals. And if we look at past history, at least as long as I've been in the game, there are usually one of two outcomes of these. Either there is an agreement relatively early on, which makes this a non-affair, or this becomes highly contentious, leading to massive congestion in itself. Last time we saw that was in 2015, where the congestion and the queues and the delays were actually on par with what we're also seeing right now. So for this one, I would expect it to get better over the second half of this year, but then also raise a warning flag over what's going to happen in 2022.
Interesting. Thanks for sharing, Lars. So a lot to watch out for there. Let's pivot to the overall transit times in the supply chain, because as we all know, there's a lot more to it than just port to port. Essentially, what matters is the total transit time for a shipment. In here, we have outlined the typical transit time for a shipment going from Shanghai all the way to an end destination in Chicago in this case. What you see here is that would typically take 35 days, give or take, all the way from cargo ready date to the final delivery at the warehouse. Now, what we're seeing lately is that this transit time has more than doubled on average, more than doubled. So we're essentially seeing this supply chain taking a staggering 73 days from the cargo ready date in Shanghai up until the delivery into the Chicago warehouse. So what's happening here? I think if you look at the final leg from discharging in LA all the way to delivery at the Chicago warehouse, it's taking a staggering 25 days. Now, what's driving that? That's in particular the fact that the rail network is severely congested. The waiting time is just all-time high. So that leg alone takes 25 days. There is actually an opportunity to shorten that by give or take 10 days, so from 25 to 15. pursuing transloading via trucking instead of going by rail. So often, that's also one of our recommendations if you want to shorten your transit time. It's not going to get you down to the historical average of 35 in any ways, but at least it can shave off some days. Now, Lars, back to you. I mean, we talked about the ports. How do you see this sort of end-to-end transit time developing for a shipment like this, for example? Is this expected to increase even further, or should we expect a drop in the near term?
I would tend to expect neither. I would not expect a drop in the very near term. It's one of these where it's a slow, protracted death, so to speak. This is going to go slowly towards some level of normality, but it's going to take time. A lot of these long transit times, it's simply due to all of these different bottlenecks that we've been talking about. And this is where everything gets interconnected, and your slide with the wheel initially was actually quite good. Because here you're talking about the transit time, which of course is of paramount importance if you're the importer. I would tend to look at it from a different perspective. Here we have the key reason why there's not enough containers in the world. Because that's actually, that's wrong what I'm saying. There's not a shortage of containers in the world. I mean, we had enough containers in 2019. In 2020, we only moved marginally more. It's not the number of containers in the world that's the problem. It's the number of days each container is tied up in moving a load of cargo. And you're illustrating it here extremely well. This is the same container, but now suddenly spending twice as much time where it is now unavailable to be used for other cargo. This is one of the core problems. And coming back to your initial wheel, this needs to be shortened in order to fix the equipment problem. But for this to shorten, we need to get rid of some of the bottlenecks. You can see, for example, the long transit time is not because the ship is sailing slower, it's because it's going to be stuck in a queue and therefore be delayed. So we need to solve the port congestion issue as one of the first things. That will shorten this chain, that will free up available equipment, and then gradually we will get out of this vicious cycle.
How about for these inland shipments, in this case, Chicago, for example, Lars, what's your best recommendations to shippers out there that have historically shipped via rail? Do you agree that trucking is a good alternative to shorten that transit time, or how do you see it?
That was a good question, and much as that is out of character for me, I would say that's one of the ones where I don't necessarily have, you say, the good answer. I would maybe waffle slightly out of it and say you need to ask your inland providers about that one, because this can change very rapidly from week to week. Is there trucking capacity available? Are the drivers available versus what is going on the rail? It is extremely dynamic.
Thanks, Lars. Really appreciate it. Let's pivot for a second to the Europe trades. And take a look at the current situation from a slightly different perspective. What are we seeing here?
Yeah, I would say we're also looking at a very dynamic situation. As also on the Far East westbound trade, almost every transport leg has extended transit times. And one of the underlying reasons for that is the high volatility in the weekly capacity. So overall, the capacity in 2021 grew about 8% versus 2019. That should be good news normally, but the high volatility is an issue. It's 8.5 times higher than in a normal year like 2019. So why is high volatility a problem? Because in weeks with lower capacity, there's less equipment coming back into China, and there's no safety stock at all available to cover for the following weeks that might be with much higher capacity. So it's like Lars earlier said, all the parts of the shipping systems are stressed to the maximum, and you cannot cover for swings in volume. So that means in weeks with high export capacity, there is not enough containers available. So in certain weeks, there's a container shortage, and that means that the cargo cannot be loaded and is already delayed before it actually gets on board. So that is basically stretching the cargo ready date to ETD time by 6 to 7 days on average. So we're also looking on the Far East westbound at structural delays at the moment.
So, Florian, we saw this volatility increasing even more when the blockage of the Suez Canal happened. Are we now sort of getting out of those woods? Are we expecting the volatility to calm down to some extent, or how do you see that?
So for June and July, we will look at a still relative high volatility compared to previous years, but it's coming down a bit to the current from the current level.
Thanks. Okay, let's take a look at the sort of outlook for global schedule reliability. So it's not all doom and gloom. We actually expect some light at the end of the tunnel here. So in here, we've shown the global schedule reliability development since the past 18 months up until now. This is global schedule reliability from the carriers port to port. Now, what we're seeing is ever since the peak of 75% schedule reliability a year ago, it dropped to an all-time low of 35%. Lately, we've seen a slight uptick to 40%. Is still very, very low, to say the least. But what to expect going forward? Well, at Flexport, I mean, we sort of have consensus around the fact that we should expect an improvement at a global average hovering around 50 to 60% come end of the year. Now, what's sort of driving that prediction? We just spoke about the Suez blockage and the aftermath of the same. And we are slowly but steady coming out of that aftermath. We also know for a fact that carriers are very focused on getting sort of the schedules back into a healthy stage. So there's a focus from the carriers to sort of recover schedule reliability. But again, this is the Flexport predictions. I would love to learn your prediction, Lars. How do you see this, not only from a global average, but also trade by trade?
Yeah, I mean, predicting the global average, that is very much at this point in time waving a wet finger in the air. So what I would rather do is lend some perspective of, do we have anything we can compare to? Have we seen this before? We have never seen it before from a global perspective, but from a trade lane perspective, we actually have. If you look at the Trans-Pacific into U.S. West Coast, we had the labor dispute in the beginning of 2015, and at that point in time, schedule reliability dropped to about 10%, which is also where it is today. And for the vessels that were late, they were something like 8 to 10 days late on average, which is exactly the same as we have today. So the reliability issue we have due to port congestion right now on the West Coast, on the Trans-Pacific, is a carbon copy of what we had in 2015. What then happened in 2015 was the moment the problem was resolved, in that case, it was the labor dispute. It took 6 months before we saw operational performance had fully recovered. So at least from historical precedent, it would appear from the point in time where we resolve the current problems, that's the bottleneck issues. That's not going to be tomorrow. That's going to be a couple of months. Then there might be another 6 months until we are back to normal operational reliability.
Thanks, Lars. So you said we waved a wet finger right there. Appreciate the candor, but how do you then see the numbers turning out? Let's say Trans-Pacific, what's the number?
I don't have a number precisely because it would be a wet finger in the air. The problem is it is out of the control of, I would say, almost anyone here, because here's the issue. What is causing this enormously poor schedule reliability is port congestion. One of the reasons for port congestion is the demand boom, but one of them is also the impact of the pandemic. Now, it does appear that the U.S. is on a path to fixing, in quotation mark, part of the pandemic problem, but you're now seeing a resurgence. You're definitely having a major wave in India. You're beginning to see a resurgence in Southeast Asia, and now you're also beginning to see issues around some of the Chinese ports, like the port of Yantian. How that is going to pan out, whether it will be resolved or not, is completely unknown. But if you do have a secondary wave hitting the ports there, that will have the impact that the carriers will be completely unable to fix the schedule reliability problem when the ports are then subject to shutdowns.
Interesting. So in conclusion, Lars, you have a hard time leaning out and throwing a number there, like
I have a hard time,
upside and
exactly.
downside.
Yeah, because that's also why, I mean, one of the advices I've been given to a lot of both BCOs and forwarders over the last 6 months is for 2021, forget anything about doing just-in-time supply chains, because that's just not going to happen. That is a recipe for failure. You have to look at resilience. You have to look at, okay, what if this continues to be as bad? What can I live with in my supply chain? How much buffer do I actually need? That is the best thing you can do as a shipper right now, rather than trying to guess exactly what's going to happen with reliability, because, as I mentioned, planning for just-in-time logistics is a surefire way to fail in this year.
Very clear. So you would shy away from just-in-time principles. Makes a lot of sense. Florian, how do you see the schedule reliability horizon on the Europe trades? Is this in line with what we're seeing here at the global average, or how do you see it?
So I would slightly disagree. So we are on a positive trend. So schedule reliability is recovering at the moment. I mean, from a very low base, but there's certain alliances, which like the M2 alliance, which are doing particularly well compared to others. And overall, I think the trend will continue. And if nothing unforeseen happens, like Lars just said, another outbreak in China would definitely hinder the schedule reliable recovery. But at the moment, the trend is your friend, and it says basically it's on a positive way, and it's recovering month over month. So by having 40 to 50% on the Far East westbound by the end of the year should be possible if nothing unforeseen happens.
Let me just jump in there as well. I mean, do we see an uptick on Asia and Europe now? I was just looking at some of the recent stats. We're actually seeing 2M go down, but even it fluctuates a bit. But here's the challenge. If I'm a shipper, whether reliability is, and there might be shippers disagreeing with me now, right? But whether reliability is 20, 30, 40, or 50%, doesn't really matter. It means I cannot rely on it arriving on time. I mean, either you're up talking, say, 80, 90%, and that is great, or it's unreliable.
Okay, so then in conclusion, we should expect improvements one way or the other. There is, of course, the big unknown, and that is a further deterioration on COVID outbreak, which could put it back down. But nevertheless, we have seen a positive trend lately. It is slowly but steady rebounding. Thanks for both of your opinions here. We really appreciate it. Let's look at the demand side of things. What is happening? We know that imports are all-time high, but what is driving it? That's the big question. Well, in this overview, we can see the fact that inventory restocking is happening in a very, very fast pace. We see that on the green line right here. Now, the challenge is the inventory to sales ratio, which is not really improving. So in reality, as much as restocking is happening all over the place, it cannot keep up with the backlog and essentially fulfilling all the orders. I think anecdotally, we've heard examples of, the delivery time of an average couch out there. From order to delivery, it can take as much as 7 months. We've literally never seen that before. This is the U.S. perspective. I would be curious to learn how you see this from a European perspective, from both you, Florian, and you, Lars. So maybe Florian, you go first. Oh.
So for Europe, unfortunately, we don't have that kind of data to that granularity. But also in Europe, demand for consumer goods outstrips current supply. That is particularly true at the moment for like furniture type of goods, barbecues, cross trainers, and the like. Now that Europe is starting to open up again, I believe that demand for those bulky goods will somehow go down over time. At the same time, shops are opening again, and they will also increase their orders. But goods sold locally should be less bulky, and therefore I foresee some relief on the maritime supply chain going forward when the countries, cities start to open up into a normal operation again.
Very interesting. Talking about bulky goods, we have a mind-blowing chart right here. Here we can see that bulky goods such as furniture, refrigerators, etc., they're up as much as 2 to 3x relative to the past 2 years in the month of March and April when we look at import volumes into the US, which is just, literally never seen before. So bulky goods are indeed driving the import craze. Back to you, Lars. Do you agree with Florian? Should we see sort of a diversification in terms of imported commodities with some of the reopening happening? How do you see this?
Yeah, partly that. There's a number of different elements at play now. The U.S. is, of course, the most extreme examples. The U.S. consumers have, to a much larger degree than the European consumers, decided that when I can't spend money on services, I'm going to sit at home and order lots and lots of stuff online. You just see that trend a lot more. But several aspects to keep in mind. First of all, even if the consumer in the U.S. tomorrow decides to rein in his spending a bit, the demand boom is going to continue for a while because we need to replenish the inventories. That's one part of it. So that's going to keep the boom running for a while. And then we have the backlog of all the cargo that's not even shipped yet, but the consumers have ordered. So the demand will definitely last for quite a while before we see it even subside. But once we see it subside, we might also get a whiplash effect where initially consumers will shift their spending over to services. Importers might to some degree then say, hang on a second, we need to figure out what's happening and hold back on ordering more stuff until they figure out what's happening. And then there is a longer term effect that could also put a dampener, because you're illustrating it quite well here. Because basically what all of these are related to are people doing home improvement projects because they're suddenly spending more time at home. And you also have a red hot housing market because it appears people are moving to larger houses. Well, why wouldn't they? Because now suddenly they have to work from home. And to some degree, that's going to be reality, not for full-time work, but for more workers. But this might then also be a one-time effect. So if everybody on average moves to slightly larger homes, you're going to buy more stuff. That's what we see now. But once you have done your home improvement, then you have done it. So then you will see it subside. And you might also have consumers that were planning to do home improvement projects and then decided, well, the last 12 months, that was the right time to do it. So you might actually see a dip in the number of home improvement projects over the next few years. So that's to say the current huge spike in demand, that can definitely persist for quite a while longer. But after that, we might come into a bit of a trough.
Super interesting, Lars. Yeah, go ahead, Braun.
Do we have a particular view also in Europe? And this is like the statistics here from the US consumer mainly. But I mean, we're seeing a similarly stressed maritime supply chain. How do you see development here?
Yeah, the problem is getting as good data in Europe as in the US. As you're probably also familiar with, Florian, the Europeans are a bit of a black hole when it comes to data compared to the Americans. Overall, it appears to me that the Europeans are not quite going to the extremes of the North Americans. You're seeing a bit of a boom, but certainly not to the same degree that you see in the Americans do here, which also means the lashback on the other side will also be much more mellow.
Okay.
Lars, that whiplash effect, the potential whiplash effect you're talking about, when could that hit? Are we talking 3 months down the line, 6, 9, 12? What's your best guesstimate?
My best guess is you might not see that whiplash effect until basically when you are either approaching Christmas or after Christmas. Because at the end of the day, this is about changes in consumer behavior. When do people decide, now I have bought everything I want to buy, now I want to spend services, buy services? It's also partly dependent on when do you feel, and this becomes more emotional than anything else, when do you feel the world has become normal? That might take a while.
Got it. Okay, so around Christmas time could be a guess. Let's see. Aside from the demand perspective and forecast, how does it look from a capacity perspective, both in terms of space on the vessels and equipment on the vessels? Lars, is the carrier order book out there essentially the coming fleet? Is that going to save the day, or how do you see this?
Save the day, that depends on which perspective you're looking at this from, the buyer or the seller. I would rather turn it around and say the order book as it is right now does not lead to no, let me phrase it differently. We are heading into a cyclical upturn. That was actually in the cards even before the pandemic. Demand is outgrowing capacity. It was poised to happen anyway. And with the even with the orders that's been coming in the last few months, that is still very much on the cards. So we're going to see a continued tightening of the market. Now, whether you are a carrier or a shipper, that will then decide whether you think this is good or bad. When could this cyclical upturn end? Well, basically when the carriers start to order a lot more vessels. And for now, even if they were to go out tomorrow and go completely crazy in ordering ships, most of those would then be delivered in 2024. So we are poised for a continued cyclical upturn on the part of the industry until 2023.
Lars, how does the current order book of 15% relative to current fleet size, how does that compare to the historical numbers?
No, that's actually very low. I mean, compared to when we came out of the financial crisis and the carriers had another ordering spree, at that point in time, you were at about 60%, so 60. So 15% is actually, in a historical sense, a very, very low order book. Now, mind you, back in the, I was about to say good old days, so 10 years plus, it was fairly normal for the order book to be in the range of about 30% or so. But that was also in an environment where global demand growth was on average about 8.5% per year. So a 30% order book was actually fairly okay when you looked at demand growth. Now you're looking at normal demand growth of maybe 3 to 4% going forward, which means that this order book is kind of okay too, because we also need to remember, even though the order book is 15%, the fleet is not going to grow 15%. There's part of this that's going to be scrapped as well.
Yeah. That's good intel right there, Lars. And we're actually seeing some of the trends you're describing right here. So if we take a look at the left side here, we can see the historical demand and supply growth the past 20 years. What's evident here is the fact that supply historically have continued to outgrow demand. And that is on top of an already existing or an already historical overhang of supply relative to demand. Now, that trend is shifting. If we look at the right side here, the forecast for this full year and next year is that demand will actually outgrow supply. So, as you just pointed out, Lars, no sort of immediate light at the end of that tunnel. The demand growth is expected to outgrow the supply growth. Anything either of you want to add here, Lars or Florian?
No, the only thing I might want to add is, I mean, if we're just looking at this one, then you're telling us for 20 years supply has outgrown demand, so we should by now have a crazy amount of overcapacity, because consistently supply has grown 1.6% faster than demand for 20 years. What we need to also take into account in that equation, and the reason why we have a tight market, is supply is usually measured in terms of what's the capacity of the global fleet. What we're forgetting here is more a matter of TEU miles. And what happened a decade ago was the carriers slowed all their vessels down considerably, which then acts as a reduction of the effective capacity, which is why, if anybody's wondering how can supply outgrow demand for 20 years and we still don't have enough supply, it's because of that slowdown process.
Interesting. Yeah, so we've seen an increase in both blankings whenever needed, and then also a slowdown on the actual speed. Is that what you're saying, Lars?
Yes.
And you would expect that to continue?
Yeah, I mean, definitely. I mean, it's been mentioned before. Well, couldn't the carriers just speed up again? Then we would have plenty of capacity. But it's not that simple, because part of this is a lot of the new buildings, they simply do not operate at the speed the older vessels had. And a number of the older vessels have been physically modified over the years to reduce fuel consumption. And by the way, by reducing fuel consumption, you're reducing CO2 emissions. Most of the carriers have reduced emissions by between 45 and 50% since 2008, to a significant degree because they've slowed down. Interesting.
Thanks, Lars. So we know for a fact that carriers on average own, give or take, 50% of their ships and lease or charter the other half. So The question is there an opportunity for carriers to charter more ships out there in this market? How do you see this, Florian?
Yeah, so the charter market, the rates also increased very steeply, particularly in the past 6 to 8 months or so. So charter rates are now like 3 to 4 times higher on average, 12 years average, 2.4 times higher. But if you compare it to a shorter period of time, even more expensive. But most importantly, like Lars mentioned previously on a slide, is also the period has increased quite a bit. So you have to charter now a vessel at these high rates for 3 or 4 years. That's much longer than it was before. And this in return leads to higher cost base for carriers, and in my mind will also lead to higher freight rates over time. I don't think that there's going to be too many new charters coming, because as far as I know, there's no vessels available to be chartered. So also the charter market seems to be sold out, even so on very high rates on long term.
You'd agree here, Lars?
Yeah, absolutely, especially in that the charter market is sold out. I usually phrase it, every conceivable ship that can sail with containers is sailing with containers. And just to give an illustration of how warped the market is, there has been a number of different freight forwarders that have chartered exceedingly small vessels, very small vessels, and have actually sailed them directly on an Asia-Europe trade, something that under normal circumstances is completely out of the question, but just goes to show how enormously tight the market is. And it ties back to my comment I made all the way up in the front, that normal operational mishaps, like just a single feeder ship having an engine malfunction, suddenly becomes a huge problem because you cannot get another ship to replace it with.
Interesting. Thanks both. What about the equipment situation or the container boxes out there? I actually went in and studied the different container availability indices the other day, because I wanted to have a better feel for like what trends are we seeing in there. And then I saw this green graph right here, the current situation relative to past years, where we can actually see that it's increasing significantly and it looks pretty positive, which doesn't sort of jive with what we're seeing out there. Florian, I gave you a call to help me understand what's happening here. So please explain everybody else what you told me.
So, like, I'm also a friend of using indices and data to understand the situation, but sometimes they're slightly misleading. So the container availability index we see here represents the shipper's own containers. So that is a small fraction of the market. I would say 98, 99% of the market is operated with carriers-owned containers. So that basically only gives you a small snapshot, a small picture of the actual situation. So, and in the carriers' own containers, there is enough containers. They're just in the wrong place, so to say. But that's also a little bit what you can see in the chart here for shippers' own. So when in the beginning of the year, basically any value below 0.5 tells you there's a deficit, and that was on a record low, was a high deficit. That means if few containers are coming in, not more. If there's no safety stock, not more containers can leave a certain port. So that's a zero-sum game. Incoming containers equals outgoing containers if there's no stock, and this is why at some point this index leveled out at 0.5%, which shows a balance. But it's only a representation of a small fraction of the market, and most likely this figure will dip over time also back into a deficit. So if you see this index, it's not directly related to the carriers equipment market.
Interesting. So what would this graph look like for the 98% of the equipment fleet out there, Florian? Is that no improvement, or how do you see this?
I mean, it got a bit more volatile. So compared to January last year, there's some weeks which are better, and some weeks are as bad as they were in January last year. And right now, container availability is becoming more difficult again. And one of the reasons is the high volatility in weekly capacity that we saw on an earlier chart. So there might be a week where you only have 240,000 TEUs on the Far East westbound that brings in empty equipment. And the next week already has like 350,000 TEUs capacity. So there's 100,000 TEUs difference. In normally, for a country like China, wouldn't be a problem. But right now, as all systems are stressed, that basically creates a shortage of containers. And we will see that until in line with volatility. Once volatility decreases, also container availability will get better if transit times also improve over time, which is then related to port congestion. But right now, still difficult. Short answer, right now, still difficult.
Also, another element to consider there is that some of the imbalance flows have actually been changed drastically over the last 12 to 14 months. Especially when it comes to equipment, it's dangerous to only think about this in terms of trade lanes. We more have to think in terms of import-export from a region. If we look at Europe, for example, sure, on the Asia-Europe trade, the imbalance is very round, say 2 to 1 or so. But here's the issue. If I have a number of empty containers in Europe, I don't necessarily have to ship them back empty to Asia. I can put cargo in them and send to North America and the like. And if I look at the sheer import-export balance for Europe as a region, it has actually gotten more towards the end of a balanced flow. There are more full containers. The problem is they're not moving to Asia. They're moving to places like North America. In North America, on the other hand, the imbalance has gotten larger. So to illustrate the issue here, if you're a European exporter, yes, the situation has become more tight. There's less of the empties that you used to be able to get relatively cheaply. And where are we sending the containers to? To some degree, we're sending them into a North American market. But in order to then exfiltrate these empty containers from North America, they need to move through these extremely congested ports in North America. And then we're again back to this vicious circle. So not only do we have challenges with the equipment repositioning, the balance of where this empty repositioning takes place has also changed over the last 12 months, throwing another spanner in the works.
Very interesting. Personally, I mean, I think where I've seen the most improvement, at least relative to 6 months ago, in terms of origin locations, would be the Eastern China ports like Shanghai, Ningbo, etc. Whereas we're still struggling with Southeast Asia ports and North China ports in particular. Would you agree both? Is that also how you see it?
I'm not sure I have a detailed enough view to say yes or no to that one. I would venture a guess and maybe flip that around as a question to you. Are you seeing that particularly around ports that are located where the container factories are?
It would be the main ports, so Shanghai, Ningbo, etc., less so the inland ports.
Yeah.
Well, I do agree with the observation. So North China is at the moment Qingdao and North, so it's more difficult than Shanghai and South. I would share that observation.
Okay, thanks both. Let's take a look at the rates and the predictions of same. As mentioned at the beginning of this webinar, it's pretty much as hard as predicting the stock market these days, or the crypto market for that matter. Nevertheless, we'll give it a shot. So we've seen the rates spike consistently regardless of the trade. In here we have shown Shanghai to West Coast, Shanghai to East Coast, and then Shanghai to North Europe. The story is the same. It's going one way, and that's up. Now, the big question is, how is this to develop the remainder of the year? What we believe at Flexport is that come June 1st, we will see another increase because of the planned general rate increases from the carriers. But then we expect a peak, and then throughout the end of Q3 and the first half of Q4, we should see a drop before we are approaching the pre-Chinese New Year peak around the Christmas time, around the December and January timeline. So the reality is that we don't expect it to go back to historical levels anytime soon, if ever. But we do expect at the back half of Q3 and first half of Q4, we should see a decline in the rates. But again, it's very hard to predict. I think many shippers out there are hoping for something along the lines of what we saw in the crypto market over this weekend, where it essentially nose dropped, but it doesn't seem to be the case based on our best predictions. But I guess, but as mentioned, super hard to forecast this. So would love your perspective, Lars. Would you agree with these dotted lines here, or do you see it completely different?
It's a good question. Before I answer it, let me say something else first, because we are so used to that the price formation over in container shipping to some degree is governed by what's supply and demand in the container shipping market. Right now, we are at a completely different regime. Right now, prices are not as such decided by supply and demand. Right now, prices are more formed by let's call it a fight between the shippers themselves. They are fighting over a limited resource. There is physically not enough capacity to serve everybody. And that means suddenly for some shippers, it becomes not a matter of what is the right price for the shipment, but it's more a matter of if I do not move my product, it won't get to the shelves. And suddenly I actually lose the sales. So it's no more a matter of do I want to pay $1,000 more or less in freight rate. It's a matter of I may lose the sale of, say, $50,000 or $100,000, depending on what I'm moving. So suddenly the value of the goods is brought into the equation. And that skews everything, which of course also means if we want to predict where rates will go in the future, then the key here is basically when will the current extreme shortage of capacity be resolved? And we again come back to especially the port congestion. As long as we haven't resolved that, all bets are off in terms of whether the spot rates will stay where they are or whether they will increase even further. That again comes down to the value of the goods. Once that bottleneck is resolved, then these curves will probably come down somewhat faster than what you're also indicating here, because then we get back to, I was about to say, normal supply and demand developments. I think we spoke about it 4 months ago. What is that normality you're going to come down to? And for that to be illustrated, you should have taken the graph back a few more years. At least my baseline is 2015 is the interesting point in time, because the markets, or rather 2014 for that matter, because towards the end of 15 and into 16, the market crashed and the carriers engaged in a vicious price war. We had a whole level shift down. As we're getting into this upcycle going forward, the last time where we had a reasonable balance was 2014. Not a good one, but a reasonable one. So once the rates come down, that's the level you're going to come down to, which is a lot lower than where we are now, but a lot higher than where we were in 19 and for that matter in 18 before the pandemic came. So to answer your question, do I agree with this one? Conceptually, yes. I probably would not think that we are going to see rates continue to spike up further than they are, but to some degree all bets are off because, again, we are linked into the value of the goods. Will they stay up as long as you're depicting there? I wouldn't necessarily think so either. That's going to be, again, down to when are the bottlenecks resolved. My view on the bottlenecks is if no more disruptive events happen, then we should be out of the woods late Q3, early Q4. So that's when the rates should start coming down. But here's the problem. I'm getting increasingly concerned about that time scale. And three things are concerning me. One is India, where we already have a severe outbreak of a new wave of the pandemic, which effectively serves to eliminate both vessels and equipment from the equation by tying them up for a longer period of time. Southeast Asia is beginning to see a wave, and then you have a potential for a secondary wave in China. Let's hope not, but if that happens, then you could go well into 22, and in that case, I mean, we could always discuss whether the peak should go up as high or as low as you're depicting here, but if the bottlenecks are not resolved until 22, rates will not start to go down until 22.
Interesting. So you think, Lars, once they will start taking a drop, it could drop, to lower levels than what we're seeing here in an even faster pace?
Yes,
but the
because
question is when.
Exactly, because what you're showing here is your West Coast rates dropping down to the plateau we had by the second half of 2020, which was still exceedingly high compared to where we were. They would drop down further than what you've shown here once they do come down. But they would not come back down to the levels you saw before they started to increase.
Anything to add here, Florian?
So for the Far East westbound, I still see that the current demand outstrips supply. So there is no good reason why the rate increases in June should not go through. That would mean in return shippers would say from 1 month to the other, we're not paying anymore. I don't think it's going to happen. So I do think that the announced rate increases for June will happen. But that is like based on the data we look at, we believe it's going to plateau out. If there's going to be additional unforeseen events, of course, this is not going to happen. But the more interesting question potentially is, so what, based on the current market, so what does it mean for future pricing strategies? So because at the moment there's a small market being on a long-term contracted rate, and a very high percentage on the market is on spot because long-term contracts have not been renewed, have been cut down in allocation and so on. So in future, what does it mean? So are we going to go back to an environment where to say there's a shipper where you're saying, I've got 1,500 TUs for an annual contract that I want to ship. In the end, you ship 900 or you ship 2,000, and that doesn't really matter to you because for a shipper, it depends what my demand is. But will the ocean market go back to that scenario? And this is where I have my doubts. I think that in future, long-term rate agreements will be in place, and that the spot segment will be larger than it is today. So I think that is something that we will be looking at. Also, while freight rates change, also pricing strategies might change.
Very interesting perspective there, Florian. Would you agree with that, Lars? How do you see this panning out?
I might see a slightly different perspective. Again, there's an element of timeline here. Before the pandemic, I had the view, which I still have, that the market here is on a gradual, slow path to eliminate, I would say, the stupid contracting of the past, where contracts were really non-enforceable from either side, and either party would renege on the contracts if the market develops strongly out of line with what was expected. We're on a long, slow trend towards much more enforceability. Now, if you ask the carriers right now, they will say that they will definitely impose extremely strong and enforceable contracts right now. Well, they're locking in contracts at much higher rates too. I don't think you're going to revolutionize the market overnight. So there are two things to keep in mind here. If, and that's of course an if, but if the spot rates, say in Q4 or Q1 next year, suddenly drop to levels significantly below the high contract rates we're seeing now, I have a hard time believing all those contracts will be quite as enforceable as they're made out to be, because we didn't change the market fundamentally overnight. But that doesn't change longer term. I do see a market that becomes a lot more enforceable. What I see longer term is a market where you have a considerable amount of cargo on spot, but that's a truly enforceable spot. You know what you get, you know what you pay. Then you're going to have enforceable contracts, but not 12-month contracts. It is exceedingly hard, both for a shipper and a carrier, to be very clear and precise on exactly which port pairs and exactly how many TEU do I need 49 weeks from now. That's a level of predictability the shipper doesn't have, and the carrier cannot be locked in that they can never change their schedule literally for the next 52 weeks. So annual enforceable contracts will be difficult. I see a market where you more get 3 months enforceable contracts, where both parties have a much higher degree of predictability of what they're doing. And then if they need flexibility, that's where they will go to the spot market. You might then also see the emergence of 2, 3, 4 year contracts, but they will be more like framework contracts between larger shippers and carriers, where it's more a matter of what are free time agreements and all the other stuff surrounding this. And then within those framework contracts, you will have these more enforceable, say, 3 months block contracts.
Very interesting perspective, and fully agree. There's no doubt that the ways of contracting will change for sure. Let's take a look at the next slide here, because same story as equipment indices for rates. The index in of itself is not painting the real picture. The reality is that the moving rates we're seeing out there, they are moving at much higher rate levels than what we're seeing in the rate indices right there. In here, we've outlined 3 examples: Asia West Coast, Asia to East Coast, and then Asia to North Europe. At the top, you see sort of the rate you would typically find in the index. And at the bottom, you see the sort of range of the actual moving rates when you add the added cost of equipment and space priority, which is essentially what it takes to get the cargo moving in this market. So the effective moving rate is much higher, $8,000 to $11,000 per 40-foot container into the West Coast, 11 to 20 into the East Coast. We have even heard examples of some 40-foot containers being moved at as much as $23,000 from Asia into the East Coast. And then finally, for Asia to North Europe, a range of 12,000 to 13,000 at these premium rates. So again, the short conclusion here is that the indices are not telling the true story. It's not the moving market that's to be found in all the premium offerings out there, which essentially comes at much higher rates. Let's pivot just before we round off into sort of solutions and how to navigate this. It's safe to say that this is all about resilience, being agile, moving fast whenever you have the opportunity to move the cargo in this market. But let's dive into a bit more detail. First, let's start with you, Florian. What are some of the best tips and tricks you have out there for any shipper navigating this market?
So there is definitely no silver bullet, but a lot of red dots, as you said. Definitely one of the best advices at the moment is basically to stick to your shipping order. So once you have a shipping order, don't change cargo ready dates or any specification of the shipment. So that's, besides booking early, is one of the best advices for the moment. Then, if you for the North American market, look at transloading, look at a direct truck versus a rail connection, at least for the time being, as rail terminals are pretty congested. Then premium services do work at the moment. That is, so if you have containers that high on your priority, look at premium services that will get your goods moving with a higher likelihood than a normal freight rate. Then consolidation, I mean, for specific SKUs that you need constant supply of and you cannot fail in terms of your supply chain, do look at LCL. Yeah? So LCL flows are somewhat more stable at the moment. And if you are flexible, that will also be reflected in the freight rates. So if you are willing to accept non-operating reefers, which have slightly less capacity than a normal container, this also is reflected in freight rates. And then last but not least, also alternative routings. So if you, for example, have port of destination as London Gateway, also consider Southampton, for example. That will definitely help you to get the goods moving. Or in Germany, if you're looking for port of destination, usually in Hamburg, accept Bremerhaven. If you're looking for Rotterdam, accept Antwerp, and so forth. So be a bit flexible on the routings. That will definitely help to move the cargo.
Thanks, Florian. Super good advice right there. Lars, anything to add? Any tips and tricks?
No, I wouldn't say it's tips and tricks. I would rather turn it around and say, for anyone still starting out with a question, how much is this going to cost me? You need to reassess, at least for the short term. Yes, of course, I know it's always important what your costs are, but the question you need to start with right now and in the coming months is, do I need my cargo to move? Simple as that. And if my cargo really does not move, and it's not just a matter of it doesn't move for months, How much will you lose? How much will your company lose? That gives you an idea of what is the price range you might want to be able to go into, because it is a game of musical chairs right now. There is not enough capacity for everyone. So it's not just let's call it the usual carriers fighting with shippers over price. Right now, it's actually shippers fighting with shippers over a scarce resource. So you have to start with the question, do I need this to move, rather than the question, what is the right price? And that is a sad message for anyone on a budget, which is literally 100% of all shippers, but that's also the stark reality right now.
Thanks, Lars. Normally I like to end sort of on a high instead of a sad message, but nevertheless, we are out of time. I hope this was super insightful. I hope that you all got the opportunity to ask a ton of questions in the app, and we got the opportunity to answer. I'll check back in with the team to look at all your questions. I'm quite curious to see all the questions, and if we haven't responded to all of them on the spot here during this webinar, we'll make sure to get back to all of you. Thanks for joining me today, Lars and Florian. Thanks for your expertise and insights. Super valuable. Have a great day, everyone.
Thank you, Anders. Have a great day, everyone.
Bye-bye.